right, let's stay there in Casablanca. The Group CEO of EcoBank Transnational Incorporated, headquartered in Lomé, Togo, Jeremy Awori, says that the number of correspondent banking in Africa is reducing, while regulatory restrictions are preventing pension funds and other deep-pocket institutions from investing in dollar-based offerings by banking institutions on the African continent. Jeremy Awori was speaking in Morocco on a panel at a three-day AFIS summit.
If we look at a bank like EcoBank, we're in 35 out of the 54 countries. We have probably 40 different regulators and different regulatory regimes. That brings a lot of complexity, which also requires explaining to customers. Customers want to do business, they want to move money, they want to trade. So what do we look for? We want to support our customers to do business. We've talked about Africa continental free trade. Now, if people are going to trade, businesses are going to trade, they need to be able to make payments. And the challenge in a lot of places is often access to capital and access to be able to move your capital. And I think we've faced a very difficult last few years with COVID, Russia, Ukraine, shortage of dollars. So what we see is more open regimes able to provide currency when people need to buy and sell goods is essential. We'd like to see more harmonization of payment rules, like you say. We also need to really focus on still keeping an eye on how we can use technology to be able to bring down the cost of payments, whether it is payments that are being done by individuals across, as you say, the cost that customers pay in Africa is in many cases even into the teens, not just the 8% Her Excellency talked about. So when funds come into the continent, we're losing a lot of value on that side. And we also need to remember trade is also not done by just big companies. It's done by smaller individuals, right? So you could be a tailor in Lagos selling goods into Lomé, right? And we want to be able to make those payments in a frictionless kind of manner. So I think if we can look at the frameworks, the regulations, whilst being mindful that ministries of finance and central bankers still have to manage things like their foreign exchange reserves, that will help. I think we're also trying to work on frameworks that allow payment in local currency. But if payments are going to work in local currency to avoid the pressure on the dollar, we need to see more trade so those currencies can move around. Otherwise, we will end up with currencies getting stuck in some locations because of the dislocation in trade. I think the last point that I would mention is really around working within a global regulatory framework that inspires confidence and trust. Because if people don't trust that their money is safe, can move easily, will not get trapped, and will be subject to the rules, the global financial rules, we will struggle. We're seeing, if you look at correspondent banking, the number of correspondent banks in Africa is reducing over time. And it's because they perceive the risk, reward, return not valid for them in this particular instance. So that doesn't encourage foreign investors to come and investors across Africa. So we need to invest in those. We need to give confidence that we are actually following the global regulations that encourage investors to come in. And then I would say, last but not least, investors want to bring their money, whether it's from one country to the other, but they also want to be able to take out their money when they need to take it out, whether it is to make investments in other countries, whether it's to pay their trade receivables. If there is that feeling that you cannot take that money out or you cannot make your payments, then we end up with dysfunctional things like hoarding, which now drives up price of currency, shortage of currency, which then makes it more difficult to make those payments.